So welcome everybody to our May Left Field Investors meeting. I'm really excited. We have Brian Burke here, and I'll introduce him in a moment. But just a couple of things. I noticed there's some new people on the call, and that's awesome. If you haven't been, or whoever's typing, if you could mute, that would be great. So if you haven't been getting emails from me, that means you're not on our mailing list. If you'd like to be, to get notified about meetings like this, just go to our website, www.leftfieldinvestors.com, and you can hit the subscribe button, and then you'll get, it's basically an email a week with a couple extras sprinkled in every once in a while, and something else is going on. And that just lets you know about our meetings, our blog posts, the podcast, everything else that's going on. So if you haven't been getting emails from me and you would like to, again, just go to the website and you can sign up. A couple items for the infielders group. Again, for the new people, the Left Field Investors group, the website, these meetings, all of that is no cost. It's free. Our community is dedicated to education and networking, and that's what we're all about. We do have the infielders site, which is a paid membership. It's right now $99 a year. It's going to be going up to $199 soon. But so we have several tools there, and one of the perks of that is we also have periodic infielder meetings, which are basically probably one every 2 months is what we kind of do. And next Monday, a week from tonight, we have You Sent the Wire, Now What, with David Shirky. I thought I saw him on the call. Maybe not. But anyway, he has a great presentation about what you do after you've invested in a syndication. So we're going to have that. We're also going to have an introduction to the sponsor summary that Chad's going to do for us. Ryan is going to talk a little bit about the forum and how to subscribe so you get notifications. And then I'm going to show off the beta version of the portfolio tracker, which I'm really excited about. It is not fully on board, ready to go, but it's really close. The other thing on the forum, we just posted where you can give us feedback on the tools that we already have, the deal analyzer and the portfolio screener. So I'd really love to get some feedback on there. So if you're an infielder and you're using those tools, please let us know, good, bad, ugly, everything we can do to improve those. That would be great. Finally, we are going to send out to all the Left Field Investor Group a poll, because we're thinking about having a get-together in the fall, and it would be in Columbus. And I realize it would mostly be Columbus people that would be coming, but we'd just like to get an idea of, would people be able to come, what day, and what time would be best. And then we're also possibly going to find an event in the fall that maybe we could all go to, somebody else's event, so you get a larger breadth of speakers. So we're just kind of trying to decide how we want to do it and what we want to do. So we're going to send out a poll. If you'd please answer that, that would be fantastic. And then the other thing I wanted to do, as I introduce Brian, I just put in the chat a link to Brian's book. And so I guess I'll start the introduction and then talk about the book. Brian is the CEO of Praxis Capital, and they've been in business for a long time. He's been 30 years in real estate, 19 years in syndications, and he's the author of The Hands-Off Investor, which is by far the best book I've read for passive investing. I don't mean to butter you up too much, Brian, but it's just fantastic. It gives you metrics that'll help you become a better investor. It talks about how to pick a syndicator, how to pick markets. It's not targeted towards syndicators. It's targeted at people like us, and it's a fantastic book. So, if you go order it through the link I put up there, I think Brian gets a few pennies, and Left Field Investors gets maybe half a penny because we put it on our website. So feel free to buy it from us and from him. It's a great book. So going on, Brian, he's got over 500 million in real estate, or he's bought over 500 million in real estate over the years and raised over $200 million, never lost a penny of investor money. So that's always good. So with that, Brian, I'd like to bring you on. And if you can just kind of fill out your bio a little bit and tell people a little bit about you, and then get started.
Well, thanks, Jim. I appreciate that intro, and you've certainly enabled my head to swell quite a bit. So you pretty much said all that there is to say. After 30 years in this business and $500 million in real estate, I think that kind of speaks for itself. But I'll try to bring myself back off of this pedestal you've put me on and bring myself all the way back down to when I was 16 years old and got my first job. I was bagging groceries, so it was nowhere near as glamorous as all the stuff that you just made my experience out to be, but I certainly do appreciate that. But one of the things that that happened to me when I was in that very first job is I met one of my coworkers there who had been investing in real estate her whole life. And when I say investing in real estate, I mean, when she was younger, she somehow managed to buy a couple of fourplexes. And throughout the years and decades had gone by since she bought them, she actually had saved up a pretty substantial nest egg when you looked at the equity that was in those fourplexes. And I always kind of aspired to that. I thought, well, that's really cool that you could do something like that. And then I got into real estate and started doing what it is that I do. And at one point she had called me and said that she had sold her 2 fourplexes and was going to be investing the proceeds in a 1031 exchange into a syndicated offering that was done through a TIC sponsor in senior housing. And while I thought that was pretty intriguing, I also knew it sounded somewhat risky, but couldn't really convince her otherwise. It was, sometimes the 1031 tax tail wags the investment dog, and so it would be. And so she made the investment. And a couple of years later, she called me in tears because she had lost her entire life savings in this transaction when the sponsor turned out to be a crook, stole all of the money, and left thousands of investors in the lurch. Fast forward to present day, he's in prison for what he did, but that didn't change the fact that her life was forever changed as she was subsequently driving for a rideshare service just to put food on the table when she should have been pretty much set for life. And it led me to a couple of things. One is just the all-out belief that nothing in this business is more important than who you're investing with. If you're investing in some kind of a deal where somebody else is in charge, that somebody else is adding a new layer of risk into that deal that doesn't exist if you're buying it yourself. And so nothing is really more important than choosing the right person. That was the first thing it left me with. And the second thing that I was left with was there's really no place to turn to learn what it is to look for and how to analyze these opportunities and these sponsors. And that ultimately led me to writing The Hands-Off Investor. And that's how that book came about, was through primarily through that story. Now I'm going to share a screen with you guys to show you just a few things that I created for you guys to talk about this. And I'm going to go on for, I don't know, about a half an hour, and then I'm going to take questions until Jim tells me to stop. So again, this is our company has grown, as Jim mentioned. We grew from a small fix and flip shop up to what's currently about 250 million in assets under management. We have well over 1,000 investor positions. I've raised about a little over $250 million from our investors in 37 different passive investment offerings. And that experience, coupled with what I saw happen to my friend from the grocery store, led me to writing this book, The Hands-Off Investor, which Jim already told you guys about. Right now, our company operates nationwide somewhat. We buy real estate in what I call growth markets across the U.S. Even though we have California, Oregon, and Washington highlighted here, it's only because we have historical experience there, not because we're currently buying in these markets. We're currently buying in Arizona, Texas, Georgia, Florida. We're looking in the Carolinas, Nevada, Colorado, Texas a little bit. These are all states where we're currently finding opportunity. I'm able to do that because I have a really solid team of guys, between myself, my CFO, my chief investment officer, and the president of my property management company, which we wholly own. Between the four of us, we've got about 106,000 units of multifamily experience. About 103,000 of that experience comes from my partners, not from me. I managed to put this whole thing together. So that's how we're able to manage such breadth and depth in our business. But let's start with some basics and talk about just what is a syndication. A syndication is really a amalgamation of what we call a capital stack, which is debt and equity. If you're going to buy this piece of real estate, you're going to need capital to come from a couple different sources. You're going to need debt and you're going to need equity. So the way this basically works is a syndication sponsor, which is what we do, and there's many of them out there. A syndication sponsor will find a bank and they'll get a bank loan. That bank loan will satisfy the debt component of that real estate acquisition. And then the syndication sponsor will have a client base of investors, and those investors will supply capital to the syndication sponsor, which will then become the equity portion. So this is really all a syndication is it's just a pooling of investment capital from a variety of, or a number of different investors into one vehicle for somebody else to invest into real estate. Now, what I find especially interesting is how widely this is used. People think that syndications are new, or this is some cottage industry, and in fact, it's been around for a long time. And families with lots and lots of money are no strangers to this. A National Real Estate Investor online study was put out a few years ago that showed that 54% of high net worth individuals that do invest in real estate through private real estate offerings. And it doesn't mean that's the only way they invest, but they do tend to invest in private offerings. And why would they do that? Why invest in private offerings? And I think the real answer here is, for investors, it's really all about leverage. And what leverage means, in the conventional sense, we think about leverage as meaning using debt to lever the equity that we invest into real estate. But when I talk about leverage in this context, what I mean is that there's different ways that you as an investor can apply leverage to your advantage. And one of those is you're leveraging your time. You can spend your time doing other things while the sponsor is managing your real estate investments, and that nothing is more valuable than your time. So syndications allow you to leverage that very effectively. You also get to leverage the sponsor's knowledge, and hopefully they use that knowledge to invest in the right investment in the right place at the right time. And you get to leverage the sponsor's team to not only locate and arrange opportunities, but also to professionally manage that asset once it's acquired, and basically allow you to turn from an active investor to a passive investor. Finally, you want to be able to leverage the sponsor's experience, contacts, and systems. Hopefully a sponsor that's worthy of your investment has all of this. That's the value that they're bringing, is that experience, contacts, and systems to source deals that you couldn't source on your own, and to manage them in places where you otherwise couldn't or wouldn't or didn't want to. Another component, back to kind of what we talked about in the beginning of leverage being a financial term, but it also does apply here in the sense that you can leverage the sponsor's financial strength, meaning that that sponsor can bring a balance sheet, cash reserves, and a credit rating to the transaction, so you don't have to put yours up. You can leave your assets completely intact and separate. You don't have to pledge anything to the bank. You don't have to keep minimum reserves in your bank account. Per lender's guidelines, the sponsor can do that with their capital, and you don't have to do it with yours. You can also leverage the sponsor's market and research skill, and hopefully they use that research skill in ways that help to make decisions and maximize performance and minimize downside risk, and also identify multiple exit strategies. And you also, this is different than the sponsor, but here you get to leverage the capital of other investors. In other words, you might be able, as a group, to invest in deals that are larger than what you could do on your own or what you would want to do on your own. Or maybe you even have enough money to do it on your own, but instead of buying one deal, you could spread your money out into 5, 10, 15 deals and get diversification that you otherwise wouldn't have been able to achieve. So those are the reasons why most investors look to passive investing as an alternative. But at the end of the day, what we're really looking for is return. So let's talk about, one example of a property that we did last year and why people are attracted to investing in passive offerings. We bought this property. It's been 3 years ago now. It was 2.5 years ago when we sold it, but we bought it for $18,575 and we sold it about 6 months or so ago for over $30 million. Our total all-in cost was about $23 million. We were able to generate a 25% plus net internal rate of return, almost a 1.8 net multiple, and almost a 10.5 average net cash on cash return to our investors over this 2.5 year hold. Our sales price of $30 million, 2.5 years after acquiring it, beat our 10-year exit sale price projection that we had forecasted when we originally made the acquisition. So in some respects, there was a lot of luck involved here. There was we picked a really good market to invest in, and that had a lot to do with it. We certainly can't take credit for 100% of that success, but nevertheless, that really had a lot to do with, or that had a really great positive result for our investors, and that's why people are investing in syndications. Looking at what people want to be looking for, you want to be looking for 5 things, and there's one thing that you should avoid when you're making passive investments, and let's run through what those are. The first one is you want to be looking at the team. You want that team to bring with them several things. You want them to bring experience, and that means market cycle experience. That means full cycle experience, and full cycle experience means that they've actually bought, managed, and sold a property all the way through. You want to see that they've brought that. You want to see local market experience, and you want to see product type experience. If they bring all of that, then they're adding an enormous amount of value. If they don't bring all of that, then you should keep looking for a different syndication sponsor to invest with. The second thing you want to find is you want to find that they have a track record. And the last thing you want to find is that they have a brand to protect. And people talk a lot about skin in the game being something that you want to find when you're investing in a deal. And skin in the game means a lot more things than how much money the sponsor is committing to that deal. It means skin in the game means that you want to know that that investor group would be destroyed if they screwed up. In other words, if they're a first-time syndicator that's never done this before, they could take the money and run, and you'd never see it again, and they could reinvent themselves and rebrand themselves at some point later, and no one would be the wiser. But if they've been around for years and years and have a brand to protect, they can't just go into the wind and disappear. That would be enormously detrimental to them, and you want to make sure that who you're investing with has that brand to protect. That's very, very critical when you're selecting a syndication sponsor. The next is suitability of the investment. And when I talk about suitability, what I mean is the investment suitable for you? And that's an important distinction because it depends a lot on what your needs are. If you have a need for cash flow, because let's say you're retired and you live off of the income, you want to know that the investment that you're making, that it delivers ongoing cash flow. If you're really looking for capital growth, then ongoing cash flow may not be a big issue for you. You might be looking at internal rate of return or maybe equity multiple, and you want to make sure that those measurements meet your objectives. The other thing is you want to make sure that the investment meets and matches your risk tolerance. If you have a very low tolerance for risk, investing in a ground up development might not be suitable for you. But if you have a real appetite for risk, and this is risk capital, and you have high return expectations, doing a coupon clipper, core, class A, multifamily at the corner of Main and Main might not be the best investment for you because it doesn't fit your risk tolerance, your investment goals. Finally, liquidity is another suitability characteristic. If this is short-term money, you don't want to invest it into a long-term hold. So whether or not you have any liquidity options, it needs to match your investment objectives. Generally speaking, most real estate syndications don't have a lot of liquidity. You invest your capital and you might not get it back for 3, 5, 7, or 10 years. And you just need to make sure that you're comfortable with that. And this is money that you're going to need back soon, that you think twice about making that investment. The third thing to look for is the market itself. And when you're thinking about market, there's a few things that I like to find in a market. There's 3 things that I call kind of the big 3 of any income producing real estate. And it really is what drives underlying fundamentals in commercial property. And that is job growth, income growth, and population growth. If you have all 3 of those things, you generally will have a fairly strong market. And what's most interesting about those characteristics of a market is that markets that have those 3 things tend to continue to have those 3 things for an extended period of time. And this kind of dovetails into a question that I get a lot about, market cycles and, when is the right time to invest, and how do I know that I'm not getting in at the wrong time, or, what happens about, if there's an adverse market cycle or, an economic recession. These questions come up very frequently. And, the best defense that I can offer investors to consider when they have these things in mind is to think less about economic cycles, because they're unpredictable and they can happen very, very quickly. Instead, think about demographic cycles, because demographic cycles tend to turn more like a battleship, where the economic cycle can turn like a fighter jet. And if it's going to take a long time to turn around, you might have a chance to recognize what's happening before you have adverse consequences. One example is I talk a lot about looking at the population trends of Buffalo, New York. Their population increased for like 150 years. And then over the period of about 25 years, it leveled off and started to go into decline. And then for the subsequent 50 years, it's been in decline ever since, and it never trended back up. And that's just an illustration of how long it takes for these demographic cycles to change course. So if you invest in markets where people are moving to, you're going to provide yourself with some defense against economic cycles. And I encourage you to do the same when you're passively investing, and look at the market and look for markets where people are moving to, and where you find that job growth, income growth, and population growth. But also underpin that with one more characteristic that's also important, and that is economic diversification. And that comes to, one of the things that comes to mind is Midland and Odessa, Texas are probably one of the best examples I can think of, where they have a lot of job growth, income growth, and population growth, but they don't have a lot of economic diversification. The population is almost all energy based. When oil has a problem, Midland and Odessa have a problem, and that can cause their fortunes to turn on a dime. Whereas if you look at a place like Dallas, for example, which isn't that far from Midland and Odessa, they have a much more diverse economic base with population growth, job growth, and income growth, but jobs in a variety of different sectors, so that if any one sector goes south, they still have a lot of economic diversification to keep them going. So again, this comes down a lot to what I call eliminating any single point of failure, and that's one component of doing so. The fourth thing to look at on our 5 things to look for is the real estate itself. And you want to see, the location of the real estate, the quality of the real estate, and the sponsor strategy. And do all 3 of those things make sense? One great example I can come up with is back in 2011, we were flipping a lot of single-family homes in California that we were buying in foreclosure. We were paying prices back what these houses were selling for in the 1980s. And we were fixing them up and reselling them at values that today would look extremely low, but at the time it was market. And it was working great. We were making money hand over fist with this strategy, but I started to see that the tide was soon going to shift. And I got a feeling that the market was going to start going up in value. And when it goes up in value, that was going to cause fewer foreclosures, less opportunity, tighter margins on flipping. And, and that strategy just started to look a little long in the tooth. So we decided, let's shift strategy and start buying houses to rent out. And so in about 2010, we made that strategy shift and started buying houses to rent out instead of flip. And I remember we were out raising money, and I at a family office conference, and a guy came up to me and he's like, you are totally crazy. He's like, this is no time to be buying houses to rent out. You should be buying them to flip. He said that the market was still in free fall. It was like catching a falling knife. And it was just a ridiculous strategy. But as it turned out, our thought was that values were going to double in 5 years. It turned out we were wrong. They doubled in a half in 5 years. And that strategy was probably one of the greatest trades I'll ever make in my real estate career. But it was really about looking at, what is the right strategy at that point. The flipping strategy, wasn't really going to work as well in the long term. And, 5 years prior to that, the buy and hold strategy wouldn't have worked at all. In fact, people who bought and held lost their entire life savings when the market collapsed. So, that wasn't the right strategy to do at that particular time. So when you're looking at investment strategies that are proposed to you, take a look at, what it is they're proposing to do with what type of real estate and when, and make sure that all those things gel together to tell a really cohesive story that makes sense. Finally, looking at assumptions, this is the 5th thing to really pay strong attention to. This is the area where sponsors can fudge the numbers a lot and make a mediocre investment look brilliant. And it's still just a mediocre investment. I think I spent at least a whole chapter, if not maybe 2, in the Hands-Off Investor, just talking about assumptions and, kind of like not only all these various assumptions that I have on this slide, but also diving into what to look for in these various assumptions. But pay attention to all of these different things that are on your screen. Rent growth, rent comps, economic and physical vacancy. Watch for big jumps in first-year income relative to the property's trailing year performance. That's one big thing people say, like, how could I tell in 30 seconds if the sponsor's projections are too rosy? Well, simple. Just look at their first-year income projection and compare that to the previous 12 months actual income and see if there's a disconnect there. If those numbers are relatively close to each other, maybe they're okay. If there's a slight jump, maybe they're okay. If there's a decline, they're probably being a little conservative, which is good. But if there's a huge jump in year 1 income, I'd be very suspect. That'd be a huge red flag, and it would immediately begin a conversation to why they think that is a smart idea and how it's even possible. Sale price projections, manipulating exit cap rates, a very common way to make a mediocre investment look great. One is this next one on here about property taxes. Sometimes it's intentional. Oftentimes it's just a mistake where the sponsors don't understand the property tax structure in the state they're investing in, and they fail to account for a possible reassessment at sale. A great example of this is in California. If you owned a property for 50 years in California, your property taxes are based off the value 50 years ago plus a 2% annual increase. But the real estate could be worth 100 times that number, and the property taxes would go up 100x. And if the sponsor is not projecting for that to happen, then their entire assumptions of future cash flow is all off base. And finally, the last one on here is the sponsor raising enough money? It's surprising to me how often sponsors just don't raise enough. They forget to account for all the little costs involved in their project, and they just don't bring enough money in. I had a guy at a conference one time came up to me and he said, yeah, we had talked on the phone not long ago, and I had an investment that I was doing. I was looking for investors. I asked for your feedback, and I said, oh yeah, what feedback did I give you? And he goes, you told me I wasn't raising enough money. And I said, oh yeah, that sounds like something I would say. And he goes, well, you were right. We didn't raise enough money, and we had to go back out and raise more money, and that diluted our investors, and it was a real mess. And so make sure that that they're raising enough money to make it happen. And I promised you that I was going to give you one thing to avoid. And that one thing to avoid is what I call the shiny object syndrome. And what this is people want to hone in on what they feel is the most important thing to them. And I want to encourage you to not chase the shiny object. What this generally is people look at return, right? So you go to a crowdfunding website and you have a choice of 50 different investments you could make, and you go, I'm going to pick the one that has the highest projected internal rate of return, or the one that has the highest projected cash on cash return, or the one where the sponsor is co-investing the most money, or whatever it is, or the one that has the highest profit split. Whatever one thing it is that is kind of like a shiny object to you, avoid making your investment decisions based solely on that one shiny object. Instead, take the totality of the investment together with all of the things that I just mentioned to you. Realize it's really about the people. Analyze the people, analyze their underwriting. Remember that garbage in means garbage out. If they're fudging the numbers, that shiny object that you're zeroing in on might not even be a real object. You do still need to know the basics of underwriting real estate. You don't have to know it, every bit of it. In other words, you don't have to know how to go and buy this property on your own, but you do need to have a fundamental basis in underwriting to some extent. But most importantly, you have to have one tool in your toolbox, and that is the ability to underwrite the sponsor themselves. Sponsor selection is critical, and I like to say that a good sponsor can finagle the best outcome out of an adverse circumstance, but yet a bad sponsor can totally screw up a perfectly good real estate deal. I try to cover how to do all that stuff in the Hands-Off Investor. If you haven't checked it out yet, pick up a copy. If you don't want to take the time to read it, ask me all your questions in the moments that follow until Jim cuts me off. But certainly if you do have questions, you can feel free to reach out to Bob in our investor relations department. His email address and phone number are here on your screen. And that's all I got in prepared remarks. You're probably tired of listening to me talk by now anyway. So I think what I'll do here, I'll unshare the screen. So if you got the information off of here, great. If you don't, grab it really quick. And then I'll turn it over to Jim. And Jim, let me know where you want me to go from here.
Awesome. Well, that was fantastic, Brian. We appreciate it. One thing I neglected to mention, if you, we're going to have the question and answer now, of course, but if that doesn't give you enough of Brian and you want more, episode 3 of the Passive Investing from Left Field podcast. Brian was a guest. It was a great episode. So just go check that out. Little shameless plug for our Left Field Investor podcast. So thank you, Brian. I think the way we'll do this is if you have a question, if you're tech savvy enough to raise your hand, and I don't know how to do that. So if you are, raise your hand that way, or just, there you go, Chad, or you can just unmute yourself when and I'll kind of call on you. That way we don't have people talking over each other. But let's start with Chad.
Oh, great. Appreciate that. Brian, thank you for your time. Thanks for joining us tonight. Great stuff. Really always enjoyed listening to you and hearing your knowledge. Want to see if I could get you to virtually sign my book for me while we're here too. Thank you. But no, I appreciate it. A lot of the mixed bag that we have with our group are some more veteran passive investors, but a lot of people are more startups, just getting into it, getting educated. That's what we're here to do, is try to educate people on the space, just because it's hard to find out there. One of the things that we've been debating on a lot, and I know you cover in your book some, is the difference between funds versus single asset passive investing. I wonder if you could talk about that a little bit, of pros and cons that you see, and what might educate some people that are looking at both sides of that in the group.
Yeah, that's a great question, and an increasingly popular question that I've been getting lately, actually, because people are beginning to see more fund offerings out there. And, one question, I just got this question the other day from a group, and they said, we noticed this new thing with the companies are turning to the fund model all of a sudden, what's going on? And quite actually, funds have been around for a long, long time. This is literally nothing new. If you think about some of the largest real estate aggregators in the world, they operate predominantly on a fund model. Blackstone comes to mind, right? Starwood. I mean, all of these large household name real estate groups are all put together by funds. You're not going to find Blackstone out there doing a single asset syndication. They would never do that. They're raising money from pension funds and a variety of other sources, and they're just combining it into one vehicle. So the differences essentially are a single asset syndication is the simplest structure to understand. It's where a sponsor, I'll use myself as an example just for simplicity of conversation, Chad. I want to go and buy this 100-unit apartment complex, and I'm going to go out and reach out to a bunch of investors. So, you and Jim and the rest of your group, you guys all contribute capital to this venture. I show you the underwriting of the asset. I show you pictures of the property. You get to read market reports about it. You can look at the rental comps, and you can make an investment decision based upon your own personal beliefs in that piece of real estate and in that sponsor. So in other words, I like that market. It's a Class B property. I like that. It's in Phoenix, Arizona. I like that. They're projecting, 4% rent growth. The market reports are higher than that. That makes sense to me. I see the trailing income versus the sponsor's projections. They seem to be in line. You're making your decision based upon all of these different factors, and you get to look at the whole picture. And then assuming you decide you want to invest, you guys all put your money into this vehicle. I go buy the piece of real estate and I make distributions. Then when it's all done, we distribute all the money out. We wind up the entity. It files a final tax return, and that's the end of it. Anything else that I'm doing during that time, other real estate I buy, you're not participating in any of it. Everything you do is contained within that one container. That's the single asset syndication model. Most investment sponsors will begin their career with their investments being launched on a single asset syndication model because it's the only way they can really raise capital. And it's very popular. Now, a fund model means that me as a sponsor, I say, I'm going to go to all of you guys and I want you all to give me $100 million, not each of you, but collectively $100 million. And I'm going to take that $100 million and I'm going to go out and buy real estate with it. And you're going to participate in all the real estate that that particular fund acquires. Now, I might draw a box. I might say, we're going to buy apartment complexes that are 100 units and up in growth markets. I might say we're going to buy shopping centers all across the US. I might say we're going to buy hotels. Whatever it is, you're going to draw some kind of a box. You have some idea of what you're investing in, but you have no idea what the real estate is. You don't get to look at the projections. You don't get to underwrite the market. Once you've made your investment in the fund, you're blindly trusting the fund sponsor to make smart decisions. So in this case, your investment decision is 1000% based upon that person that you're investing with, and that you trust that they're going to do the right thing. And they have to have an extensive track record to show you that they've done it before and have been successful. And you're going to base your decision based upon that track record. Now, the downside and upsides, the upside of a single asset model is you get to underwrite everything, the real estate, the market, and the sponsor. The upside of the fund is that you get diversification. You can make one investment and you could invest in many properties in many locations. And one of the things that I try to encourage people to do, and I mentioned it in the slide presentation, was to minimize your single points of failure. And when you invest in a fund, you've eliminated the single point of failures in that. You're not just investing in one property. There's one. You probably aren't investing in just one market, although some funds do. They'll say, we're only going to buy apartment complexes in Phoenix. That's it. So in that case, you don't get geographic diversification. But assuming that it's a diversified fund where they're buying across the US, you can get market diversification. And you could even get asset class diversification where there's some A class, some B class, some C class. Some funds, real estate funds, might invest in like hotels, shopping centers, apartments, and kind of get even different diversification way in that respect. Or you could invest in different funds that specialize in each of those different disciplines. But that, what you're trying to do is just reducing those single points of failure. But there's one single point of failure you haven't gotten rid of here yet, and that is sponsor diversification. So I encourage you that if you are investing with any sponsor, that you don't put all your money with one. Spread your money around and reduce those single points of failure. Now, the disadvantages of a single asset syndication: no diversification. The disadvantage of the fund: you don't get to see the assets until after they're acquired.
Oh, that's great stuff. Thank you.
Okay, I got one on the comments here. Can you talk about the importance of break-even occupancy?
Yeah, so first let's kind of talk about what break-even occupancy really even is. The way I define break-even occupancy is really more about income than it is about physical occupancy. So there's a couple of ways to look at break-even occupancy. The simplest way is this is the kind of the conventional method of thinking about break-even occupancy. You say, okay, if the property is 75% occupied, does it still positive cash flow? That's a very common way of looking at it, but it's overly simplistic. The problem is what if 25% of the residents aren't paying, and you've completely, kind of forgotten about that component? Or what about if one of the units is a model unit and it doesn't generate any revenue? Or what about the units may be occupied, but some of them aren't generating full rent because they're getting a concession, like 2 weeks free, or they're getting a discount on their rent. So instead of looking at it as break-even occupancy, I like to look at a different measurement that I call default ratio. And what default ratio is it's a measurement by taking the effective gross income and dividing that by the sum of the debt service and the expenses of the property. And what this is giving you is it's telling you how much can the property go below your projected economic income, effective gross income, before you get to what we call a 1-to-1 debt coverage ratio. In other words, basically dropping into negative cash flow. And so if you are staying above an 85% default ratio, that's generally considered to be within my risk tolerance zone. It's within most banks' risk tolerance zone. And what an 85% default ratio means is the income, not the occupancy, the income can fall by 15%. So you take 100% minus 85, it can fall by 15% before you get into negative cash flow. If the income falls 20%, then you're in negative cash flow. Now that fall of income means, if the property is at 90% occupancy, that means that you can fall 15% income beyond the 90%. So you might be at 85% occupancy and 10% of bad debt and 5% going to concessions, and you're in negative cash flow. Or you could be at 100% occupancy and have 10% bad debt, 5% concessions, and 2% for non-revenue model units, and you're in negative cash flow. So resist the temptation to think about break even as being related to physical vacancy, and think about it as a big picture of total income.
Awesome. That's a great way to look at it. Ryan, did you have a question? Oh, he can't have any audio. He says, how do your exit strategies change as we head into different market/economic times? Hold on. Sorry, I didn't fit. He loves the demographic versus economic comment earlier, but wondering how your strategy changes to assume different strategies.
Well, your strategy just has to be mobile. I always like to say that investing in real estate is like rowing a boat in a stream that meanders through a meadow. And if you've ever seen a stream in a flat meadow, that stream will go left and go right, and it zigs and it zags. And if you're rowing and you only row straight, you're going to run aground, right? So you have to be prepared to turn. You have to be prepared to pivot. You have to be prepared to stop and know when to go. And a lot of this is, I use a lot of intuition, and kind of, sometimes that's difficult to put into play, but intuition plays a big role in it. Also looking at data and staying ahead of data. And the bottom line is there's no way that you can accurately predict a market cycle, and there's no way you can outmaneuver it because they're too quick. I mean, think about it. March 10th of 2020, the economy, by all reports, was literally on fire. I mean, things were screaming. March 20th of 2020, the world came to a grinding halt, and everybody was wondering if all real estate was going to wind up in foreclosure. There's no way you could have outmaneuvered that. So instead, what you have to do is you have to set yourself up to be able to have the flexibility to make maneuvers. In other words, don't take on too much debt. Keep your financing low so that when things don't go well, you can wait it out and you can sell at the next market cycle peak. So your exit strategy might go from, we're going to sell in 3 to 5 years, to we're going to hold it for 10 or 15 years because we have to get to the next market cycle peak. Or your exit strategy might change to, we're going to sell at a loss if we have to, just to get the hell out. It really depends upon, what your investment projections were from the get-go, and what flexibility you have, and what's backing you into a corner. But you have to be prepared to pivot at any time and change your strategy just based upon what appears to be working at any given time. And you may or may not get it right. So your best defense, watch those demographic cycles and invest there, and finance conservatively, and be prepared to ride it out. That's my best advice.
Okay. One more question before we get to Adam. This is a quick one. Is Praxis Capital open to non-accredited investors?
Sometimes. It really depends on the investment. We had a fund that we launched last year that was 506C offering. It was limited only to accredited investors. We launched a sidecar about a month or so ago. That one was open to unaccredited investors. So it just depends. If you're interested, the thing you need to do if you're non-accredited is start a relationship with us, have a conversation with us, get on the list. Bob will set up a call, let us get to know you, and then you'll find out when we have something that would be applicable.
Perfect. Okay, Adam.
Hey, Brian, thanks for taking my question. I was just curious to hear what you think is sort of the biggest, I guess, macroeconomic or global risk to the real estate market right now, or if there is anything that kind of keeps you up at night.
Well, it depends on what sector of real estate you're in to a certain extent. If I was a big retail owner, I would be scared shitless. I mean, it's you know, the conversion to online shopping is going to change the landscape of retail investment, I think. And so, you know, that one is an obvious one. In the residential sector, which is the sector that I really focus 99.5% of my energy, I am very bullish on the outlook because we have a housing shortage in a lot of areas. Now, if I was investing in some markets where people are fleeing from, like if I owned in San Francisco, if my portfolio right now consisted of a bunch of $4,000 a month Class A apartments in San Francisco, I would probably not be sleeping at all. But in the workforce housing sector of, you know, kind of mid-priced apartments, I don't have immediate major concerns. But from a macro level, I mean, even interest rates, people are like, oh, what about interest rates? Yeah, I'm not really extremely worried about interest rates. I am worried about maybe a possible debt implosion. You know, what's going to happen if, because this is probably the biggest risk I can imagine us facing in the residential sector, especially in the commercial residential sector, which is over 5 units. If there's a massive, I follow this one economist, he calls it the Great Reset, right? There's being so much government debt and corporate debt and so forth being taken on that someday somebody's going to have to default on this stuff. And if that happens and there's like these massive debt defaults, that's going to cause capital providers to get very skittish, and it's going to make debt very difficult to find at any price. And if we have our debt, great, you know, we can ride it out. But the problem is that if we want to sell, our buyer needs to get debt. And if debt isn't available, that's going to dry up the buyer pool in a heartbeat. So I think that's probably our biggest macro level risk to me.
All right.
Thanks.
We'll do maybe one more question. Jeff, did you have a question too?
Yeah, I can defer to whoever else had one though.
Okay, we'll do two more. We'll go with Jeff and then Jay Wright. Sorry, I don't know who that is, but you can go after Jeff. And then we'll do two questions, Brian, then we'll close up.
Sounds good.
Brian, great presentation. Thanks for taking my question. Maybe taking a turn. So I'm an investor in your value fund, but also in the Riverbend debt fund. And I'll be the first to admit, I really don't understand the debt fund. And I don't know as simple as maybe it should be, but are there things to maybe we as investors, when we go invest in debt funds, to think about? I know some sponsors, you know, offer different interest rates and such, but I'm sure there's different risks with different sponsors. What should we be thinking about there in debt funds in general?
Yeah, great. That's a great question, Jeff, because most people don't talk much about debt funds. The main things to be concerned about in a debt fund is the underlying debt that's being held on the books of that debt fund. And so, like, if you're investing in a mortgage pool that says, you know, we're a hotel lender and, you know, we're originating loans on hotels nationwide, and we keep those loans on our portfolio, et cetera, et cetera. What you need to spend your time investigating is, what is the hotel market like? Because whatever sector of real estate that debt fund is lending to is the underlying support for the success of your investment. And if hotels all fail and then they start defaulting on that debt, and that debt fund gets a bunch of debt defaults, that's ultimately going to trickle down to you as a debt fund investor. So understanding kind of the underlying real estate that's being lent on and what their lending guidelines are makes a difference. And, you know, I talk about this so often when people ask about returns and it's like, oh, what return should I be expecting in whatever investment it is you're looking at? And the reality is it all comes down to a risk adjusted return. That's what's really important, is like, if I'm taking on this much risk, what's it worth? And so if you have a choice between two debt funds where one's investing in hotels and the other is investing in apartment loans, and they both are offering the same rate of return, those are two different risk profiles, right? So you would think, okay, well, in the hotel debt fund, I would want to earn a higher return because there's more risk there in the underlying assets. That's really the most important thing to understand. The other thing to understand is their strategy. And, I don't want to get too much into, what the Riverbend debt fund here and sound like a salesperson, but the difference, what Riverbend does is really a mortgage banker, and we don't hold loans on our books any longer than necessary to offload them and sell them to another investor, which is a major financial institution. So we've really managed to cut out most of that underlying real estate debt risk by offloading that loan off of our books as quickly as possible. So we can never say we've eliminated all risk, because there's always risk, but we found a way to drastically reduce risk. And that's much different than another debt fund you might look at, where they're actually holding all of their loans on book, and you have that sort of default risk. So really look at that real estate. And there was Jay Wright was the next question, right, Jim? You're muted, Jim.
Yeah, thank you. I think that's John up there. Sorry, I was muted. John, you have a question?
Oh, yes. Hi. Hi, Brian. This is John Wright calling. I'm new to the group, and I'm new to investing in passive real estate. And I just invested in my first deal. And one of the things that kind of, you touched on a couple questions ago was about, being able to weather the storm and go through a market cycle. So for instance, investing in multifamily, and with interest rates so low, I would think it would make sense to secure the debt as far out at the lowest rate, right? So if they can get a 3% interest rate fixed for 10 years, that would potentially enable us to weather a storm if we did have a correction or a crash, to allow that asset to come back and then sell it. So if the exit strategy was to sell it in 5 years, and there was a crash or correction that happened, let's say in year 4, that they would be able to hold that asset, that multifamily, until year 8, 9, or 10, and then sell it and make a profit. This particular deal that I'm investing in, they're doing interest only. I think it's like 3 years, because their projection, right, is they think they're going to be able to sell it, right, in 3 to 5 years. That's the exit strategy. But if a correction happens, let's say right when they were planning on exiting, now what? What if they don't have secured long-term debt, and the credit markets tighten up? How likely is it that they're going to be able to go back to that bank and say, oh, we're going to have to hold this project for another 5 years? Can we refinance, or can we secure a low interest rate for the next 5 years? I guess that's my concern. I know it's kind of disjointed because I'm new, but that's kind of where my thought process was.
Yeah, John, that's actually a very, very good question. And first of all, congratulations on making your first passive investment. I know that's a big step to take. So congrats on that. Second, I really encourage you to read the book. And I don't say this because I make money off this book. Full disclosure, I make pennies off of this thing. It's nothing. That's not why I wrote it. I wrote it because I want people to be educated in what they're investing in. And there's a whole chapter that I dedicated in this book on finance and the structure of finance and how it impacts returns and how it impacts risk. Because unfortunately, in the commercial real estate space, there's no free lunch. So in as much as your comment is 100% correct to have a long-term fixed rate debt package enables you to survive a long in the tooth cycle. Like if you needed to hold, you got that debt there. It also introduces some risk. So I'll try to be as brief in this answer as I can out of respect for everyone's time, because I know we're running up against the hour. Jim told me he was going to kick me out of here. But I want to give a thoughtful answer to this question. Okay, so in commercial real estate, it's very difficult to find, if not impossible to find, 30-year fixed rate financing like you get in the residential home sector that you're familiar with. Like on your own home, you probably got a 30-year fixed rate mortgage. You never have to worry about your interest rate going up. You never have to worry about your payment changing, and you can sell your house at any time, and you can hold it until it's paid off. And it's a great financing package, but it's also subsidized completely by the government, which is the only reason why that money is available in the first place, because Freddie Mac and Fannie Mae, they offer these financing packages. In the commercial space, it doesn't exist like that. There's always trade-offs, and it's difficult, other than a HUD 223F loan, it's difficult to find long-term financing that goes beyond 10 years. Even the agencies will limit their financing to 10 years, even though it may be amortized over 30, it's due in 10. So there's always a balloon payment. 10 years is better than 3. So to your comment about the 3-year financing package your sponsors have, if they get to year 3 and can't sell, they're stuck. They painted themselves into a corner. If they had 10-year financing, they could ride it out for the full 10 years before they'd be stuck. And that gives plenty of time for the market to change, for the property to appreciate to such a rate where a refinance is easy, because the loan to value ratio would theoretically be so low. But it introduces a different risk profile, and that's what's called a prepayment penalty. In this particular instance, they call it yield maintenance. And if you go and get a 10-year fixed rate loan on a multifamily property, for example, and then you end up selling it in year 3, like let's say your business plan is to sell in 3 years, and you actually you're able to sell it in 3 years, you're going to pay a prepayment penalty on that fixed rate 10-year loan that could be in the millions of dollars. In fact, there was a transaction recently that I was looking at. The prepayment penalty on the loan was $19 million. That's just the prepayment penalty. And that's all money that, if they didn't have a prepayment penalty, would have gone to the investors. But instead it will go to Fannie Mae. These fixed rate loans introduce that new risk component. And how do you navigate that? That is a challenging one. And a lot of sponsors overlook it. They don't understand it. They don't know what it means. And they do it anyway. And then they end up selling. And at the end, they go, oh, whoopsie. Hey, investors, we were supposed to send you $7 million, but we can only send you $4 million because we had to give Fannie Mae $3 million to pay off our loan. We didn't realize that was going to happen. We're sorry. And you didn't even know about it until after the fact. So there's a lot of different elements to financing. Personally, what we use, my go-to financing vehicle, is the 10-year agency floating rate debt package. I get 10 years for maturity, so I don't have to worry about getting painted into a corner. I can pay it off at any time after the first year and only pay a 1% exit fee. So that means I don't have this big yield maintenance thing hanging over my head or influencing my decision on when to exit. The flip side is I have to take interest rate risk. And, if rates float up, then my payment will float up, and therefore my distributions to investors will be less. And I can mitigate that through an insurance policy called a rate cap. And we do that, but we are taking on interest rate risk. So you have to be able to analyze the market and decide whether interest rate risk is too great for you or not. And so long answer to a question that really boils down to, there is no correct answer here. Different financing packages will impact different things. And if you read that whole chapter, you'll get the full picture.
Excellent. I really appreciate it. That was very helpful. And yes, I'm buying the book.
That's great. At least we earned you some pennies today, Brian.
Right. Absolutely. That's a nickel I'm going to go put in the soda machine in the.
Well, thank you, Brian, so much. This was fantastic. It was a great meeting. You can tell we went over, which means everyone enjoyed the content, had great questions. So thank you very much. so if I will put in the video tomorrow when I post it to the page, I'll include the contact information for Bob. If anyone wants to contact you guys, they can do that through Bob. So at this point, we are going to go into networking. So anyone who doesn't want to be in the networking can just log off, and I won't assign you to a room. If you want to stay in the networking, just give me a couple minutes. And again, one last thank you to Brian. We really appreciate it. It was great chat. Thank you very much.
Thanks for
Great
having
stuff,
me,
Brian.
guys. I really appreciate it. Thank you much. And I'll see you guys next time. Hopefully we have you back.
Excellent. Absolutely.
All
Take
right.
care,
Thanks,
Brian.
y'all. Thank you. You too.